Hi, I'm Ela Lange, co host of Dollars with Sense radio show and podcast, here with my fellow financial guru, Terence Vanderwood.
Hi, Ella. Thank you very much. And thanks to everyone for joining us today. Comprehensive financial planning is our passion, and helping people grow and protect their wealth is our mission. Contributing to your registered retirement savings plan, or your RRSP, is one of the most beneficial and efficient ways to both save for retirement and reduce your annual taxes. So that is what our topic is going to be today. All the details around RRSPs.
All of January and February, in fact, Terence, is what we're going to be focusing on, RRSPs, as we will be helping you find the best ways to use your RSP. It's the season to contribute. And as Terence said, it reduces your taxes and it also helps build a retirement nest egg.
So last week, the first episode of 2017, we talked about maximizing your RSPs by finding your notice of assessment, or otherwise known as your NOA, your 2015 NOA. So now that you have all your NOAs in front of you, you are ready to take the next step. So if you have done so, let's begin. But wait, I think Ella has a question or two before we start that.
We have so many terminology things that come up in our conversation, so it's a good thing sometimes to just identify what things mean. Terence, can you walk me through compound growth, please?
Certainly. Compound growth is growth that compounds. No, I'm kidding. But I'm ching. No, compound growth it's a very simple concept once you put numbers to it. So let's say you have $10,000 and it earns 5%. That means that at the end of its earning cycle, whether that be a month or a quarter or a year, then the $10,000 is now worth $10,500. And then the year after that, you will earn 5% on $10,500, then on just $10,000. And by compounding your investment, you will get compound growth.
Okay. I'm going to give you another one here. What about tax deferral? Tax deferral, please.
Tax deferral. Well, there's a lot of words that we have, like you said, that are very similar. One is tax preferred, and the other is tax deferred. So of course, it's very close. But tax deferred refers to an investment that defers the taxes until later on. That means that you still have to pay the taxes on whatever it may be, on whatever the investment is, but it is deferred until later on. And that's where RRSPs come in, because they are tax deferred. You are able to defer the taxes on your RRSP contribution until you have retired. So essentially, when you put your money into an RSP, you are, as I said, deferring paying the taxes on that contribution until you're older. And in the most maximum age you can be is 71. After that, you have to withdraw your RSP contributions as an income, and then you will be paying taxes on that. You may pull your money out earlier if you choose to do so, but then again, you will be paying taxes on those monies that you pull out. So the less tax you pay, the more money you will have working or towards your retirement goals. Again, yes, exactly. Going back to that compound growth. Your RSP is one of the most powerful ways to protect your investment from taxes. Not only do you enjoy an immediate tax deduction for that year, but your earnings within the plan grow and compound on a tax-deferred basis until you withdraw your money from the plan. Remember, a $10,000 RRSP contribution could equal to $4,700 in tax savings if you are in the highest tax bracket. Throw in the benefit of a tax-deferred compound growth, and RRSPs, as I said, become one of the most efficient tax-saving strategies. What's more, if you use the tax refund you receive, you can use that money to either make additional RSP contributions, tax-free savings account contributions, or make an RESP, which is known as a registered education savings plan for your children. You can make contributions or pay down your mortgage or pay down your RSP loan
Or
or
you could go on holiday, or you could go out for dinner with your family. You could buy yourself a very expensive pair of shoes.
well, you could do that, Ella, if you wanted to. But as you know as well as I, because it's your money, you can do whatever you want with it. But as a financial planner, I would highly recommend you save the return for your future self. One of the easiest strategies to maximize your contributions is to use up any unused RRSP contribution room you may have.
Okay, and where am I going to find out that information, Terence?
Well, as we said before, and as you well know, the unused RRSP contribution room is reported annually on your income tax assessment from the previous year. So for all of you who have your notice of assessment in hand this fine day, you can find it on page 2 at the bottom of the page on the right hand side, and you'll see an example of it coming up on your screen right now. This one is a particular example from the ability to actually download your notice of assessment from the CRA website. Ella will talk to you more about that.
Yes, so if you'd like to find your NOA, you can follow along with us, or certainly you can check out your assessment online at the CRA website, and that information is coming up on your screen right now, and you can always go online and check it out, or just follow along with us. We've got an example of someone's 2015 notice of assessment. Of course, we've blocked their names out and all the other information, so I'm not sharing that with you, but we will share with you how this individual's NOA looks like. So at the bottom of page 1, you'll see that this individual's total income for 2015 was $90,835. So you'll see on page 2, we'll take away some deductions and other tax credits and so on and so forth. But the area I'd like you to direct your attention to is the RRSP limit statement. And see, they've also included the same website page there for you if you need to find it. But the deduction limit for 2015 is noted there as $50,297, minus any employer's PRPP, nothing there for this person, minus any allowable RRSP contributions deducted for 2015, nothing there either. You see 18% of 2015 earned income up to the max at this time was $25,370. For this person worked out to be $15,928. Minus a pension adjustment, we may see is $12,201. So that's what this person's pension contributed by this person from his pay, which will deduct the limit of contribution room to an RRSP. And after, again, minus the 216 net past service pension adjustment is near nothing. 216 pension, 2016 pension adjustment reversal, again, nothing. Your 216 RRSP deduction limit totals $54,024. So the grand total of available contribution room for 2016 is $54,024. And that's above and beyond what this person has contributed to their pension. They can put that amount of money, maximize if they wish, $54,024 to their RRSP.
Great, thanks, Ella. And so your NOA, your Notice of Assessment, page 2 at the bottom, you'll see the available contribution room for 2016 on your 2015 NOA. Thanks again, Ella. So since 1991, for any year that you have not maximized your RRSP contribution, you have been accumulating unused room. So in the example of the NOA that we have, her unused room was the first line item at the bottom section of page 2. PRPP deduction limit for 2015 is $50,296. So that's her unused room previous to beginning of 2015. For this year, your RSP contribution room consists of the unused contribution room from previous years plus new contribution room generated based on last year's earned income. And as Ella said, that was the plus line item where it's 18% of your 2015 earned income or a maximum of $25,370. If you have unused RSP contribution room, it does represent a potential tax deduction plus the added benefit of tax-deferred compound growth. Again, a great way to maximize your retirement savings.
If you have substantial unused RRSP contribution room, but no money to make a contribution, consider using existing savings. For example, if you have non-registered mutual funds or a GIC that has come to maturity, cash in the bank, or any such savings, you can contribute them to your RRSP. Just watch out for cash flow. If you're relying on that money for an emergency reserve, you probably don't want to dump it into an RSP, as you will be charged a withholding tax if you need to withdraw.
Yes, good point, Ella. Let's take the first example of mutual funds from a non-registered account. You will receive a tax deduction equal to the investment's current market value at the time of the transfer. But be careful, as you could trigger a capital gain at any time of transfer, and also not all investments are eligible to be held into an RRSP. As well, any loss created by this in-kind contribution cannot be deducted from any other capital gains. As this can be confusing, we can help ensure this strategy works for you. We can, as your financial planners, or if you have another great financial planner, that can help you out with that as well.
Alternatively, you could consider an RSP loan to catch up with a large RSP contribution room balance. So rates are very competitive, and although you'll pay interest on the amounts borrowed, the long-term benefits can far outweigh the interest costs. In addition, your contribution could trigger a tax refund. Yay! That could be used to pay down the loan and keep interest to a minimum. So, how do I figure out how much to contribute to my RRSP? What makes the most sense?
Well, that depends. I know that most people hate it when you hear that, but unfortunately, we say that a lot in our business. That depends. Yes. But that depends because, well, tell me, Ella, what is your retirement going to look like?
Well, I was going to say it depends on how much money I make, and it depends on what my, intentions are at retirement. So my husband and I would love to buy a sailboat. We know that's going to be money thrown right at it constantly, so I'm going to need some capital to keep that alive, that dream going. But, of course, after my son's finished university, I'm hoping he's on his path of earning his own money, and my husband and I can concentrate on ourselves. But at the end of the day, I need to know all of those factors make a big, big difference in how much I will have in my retirement.
That's true. All those factors do have to be taken into consideration, and every person is different. I've said it many times before. Finances are like fingerprints. Everybody has one, and everybody needs to use one, but they're all unique. Every case and every scenario is different. I'm constantly amazed when meeting with new prospects and new clients at how different everybody is. Through a sound financial plan and at investors groups, we're a leader in the financial industry with the capability to price out the retirement wants and needs and distill it down to a monthly cost starting today.
Amazing.
Proprietary software that we use can allow me to tell my clients, based on the assumptions of their lifestyle habits, i.e. traveling and food, how much food they want to eat, sailboat or not. Yes, right. Your sailboat, of course. How much taxes you will be paying, let's say, for example, when you're 76 years old.
Amazing. The Investors Group Personal Financial Plan software can put in writing the projections as to how much exactly you need to save today for the retirement of your dreams. Every dollar you set aside today will have a tangible impact on your retirement income. And in retirement, if your investments earn 7%, which would represent a moderate portfolio of investments in mutual funds, for example, here's what your pre-tax income stream from a registered retirement income fund, or as we often call it for short, RIF, looks like based on the total amounts accumulated over a 25-year retirement. As you can see, utilizing your RRSP contribution room can now make a big difference in your future retirement style.
Yes, so how we calculate how much you have if you're earning 7%, again, the reasonable rate of return, especially for a moderate portfolio. We have a great, we call it the rule of 72. It's not a concept. It's an actual way to figure out how much your investments will return. So what you do is you take the number 72, divide it by the interest that you're receiving, and it equals the number of years your investment will double. So it's a lot to process, but let's do an example. 72 divided by 7%, let's say a 7%, a reasonable rate of return, that will equal to 10 years that it will double. And that's how the rule of 72 works. Right, Ella?
Correct.
I'm not just saying.
No, absolutely. That's what we use on a regular basis, and it shocks people, but we have projections to show exactly how that works out with just a quick, simple calculation.
We have software to show it, and we also have thousands of cases from fellow senior planners who have been around for a longer period than either Ella and I, that time and time again, 7% is a reasonable rate of return, and it doubles every decade. So if you want $400,000 for your RSPs, and you've got 25 years of saving to make that happen, right? If you could do it all in one lump sum, that would be the easiest amount. So with the rule of 72, if you wanted $400,000 for 25 years later for your retirement, if you had $70,000 to put away right now, and you put that in, then that would equal to about $400,000, $420,000 to be exact, in 25 years. If you had the ability of putting $70,000 away today, you would never have to save for retirement again. It's a very interesting concept. Most people don't have $70,000 to put towards their RSP. So then what we do is we figure out how, going back again to the $400,000 goal, and then we can divide it up so that it becomes a monthly amount.
Keep in mind, folks, that these are suggestions as they are concepts and strategies that we discuss, of course, based on market. And markets are volatile and don't always give us our 7% return. But as we've said before, time is on our side, and regardless of any dips in the market, time has helped those dips recover. And we've seen consistently that people who do save and save over a long period of time end up with that compound growth and substantial savings for their retirement. So projections only, these are estimates and strategy, and so should not be misunderstood as guarantees.
Yes, that's an excellent point, Ella. And remember, again, going back to each person is individual and each person's scenario is different. So before any action is taken, make sure that you have a personalized plan for you, either through, you can contact us to financialgurus@gmail.com, or if you have an advisor that you use, please go to them and make sure that you figure it out before taking any action on it. Speaking of action items, Ella, tell us, what's our action item for today?
Okay, so we all last week and this week have used our NOAs. Keep those handy because there's lots to learn still. And that way you can check out your unused contribution room. Reach out to your financial planner to understand what contribution makes good sense and what would be an estimated return.
If you do not have a financial advisor that you can ask to get an estimate of what your return will be, guess what? Your two financial gurus are great financial planners, and you can connect with us. So if you have any questions or you want to look through it, please connect with us. You can contact us by phone at 778-879-0820. You can also contact us by email. We have 2financialgurus@gmail.com. That's the number 2financialgurus@gmail.com. We would love to answer your questions that way. You can also check us out on Facebook. We have our Facebook page, Dollars with Sense, where this episode will be available, as well as you can leave comments there. Please like us if you come by, and you can also get updates from us that way. And you can contact us through YouTube. If you subscribe to our channel, you can just go into the YouTube search bar, punch in Ela and Terence, And we will come up and you can leave a comment there. Subscribe if you want to get an alert for their next episodes. We have over 40 to choose from on our YouTube channel, and we'd love your feedback on these programs. So thank you, everyone. Please reach out to us if you have any questions regarding today's action items, which is contact your financial planner to be able to figure out exactly what your contribution room is and your estimated return.
Thanks, everyone, for joining us this week. And thanks to everybody at 98.7 The Point for broadcasting these episodes week after week. We wish you all a fantastic week ahead. And may your dollars and cents be with you.